in the discussion, we found out that a much better plan was to utilize the deferred sales trust now. And in a couple of years, when the timing was better, because now they could have control over if and when they do something like that.
Now we also want to talk about the ability to make this an investment and not an expense, okay? And Jake touched on this a little bit, where people move out of state. They can start to receive the income from the trust slowly as they maybe have delayed the income for a year or two. When they sold, let's say in New York or California, and they moved to a place like a Florida or Tennessee or Texas, or it's a lower income tax state. The neat part about the deferred sales trust and the way you make an investment, not an expense, is by establishing residency in a new state and then start to receive income in that new state, right? Because it's ordinary income tax on the interest payment. So it's kind of like if you had a big pension and you worked for the state of California or New York your whole life, and then you moved to a place like Florida, and then you start getting the pensions payments from wherever, right? Well, guess what? The ordinary income tax is in that new state. So that's a cool way to do this. Now, we have entrepreneurs that are selling businesses, and typically they're staying on for 2 or 3 years as an earnout. So part of the strategy is to delay the payment from the trust while they're still working. Now, it's still compounding and building interest, typically at 8%, but then they start to receive it over time when they make sense for them. We call that optimal timing on the tax payments. So that's a great way to make the deferred sales trust an investment and not an expense. Jake, any thoughts on that?
It becomes a tool. And I mentioned it once before, but it's kind of like the keystone tool amongst several other strategies. We work with attorneys that sometimes bring their clients to the table. Sometimes they've done some initial planning before they found out about us. And occasionally they're working with, the lack of marketability. So we're going to decrease the value of the business so that we can be gifting at a lower value. And they come up with these very other complex strategies that they might still implement, but at a lesser degree based on what we're able to do with the deferred sales trust. So it kind of moves up into the keystone or the main focal point of what we end up doing for the client. And then a lot of those other strategies either become unrelevant or are able to be utilized, but at a lesser degree in a more appropriate way. An example, we were talking and discussing with some people in California who had a business, and they're going to sell it for $10 million. And they were looking at the options available to them. They were considering a charitable remainder trust, and they were considering all of these things that they could do to mitigate $10 million worth of, a transaction. And at the end of the day, even though they're very charitably minded, they weren't necessarily $10 million worth of charitably minded people. They didn't necessarily want to give away everything at some point, but they did maybe want to give away 10% of that. So in the discussion, we found out that a much better plan was to utilize the deferred sales trust now. And in a couple of years, when the timing was better, because now they could have control over if and when they do something like that, they could do a much smaller, perhaps $1 million type of transaction for that charitable desire, rather than making it fit, the round peg into a square hole. They were able to coordinate and do things more appropriately based on their desires because they had the more flexible tool of the deferred sales trust.
Yeah, very well said.